And I'm sure that's a similar thought that comes to our wealth managers' minds when it comes to handling their wealthy clients. If there could be a guide that will help them understand the HNIs in a much better fashion. So to decode this mystery, today we've set up a panel of 4 wealthy clients who will take you through the expectations. Yes, Arif, wealthy. So they will share their experiences and expectations that will help you handle your clients in a much better fashion. So to moderate this session, we have Ravi Trivedi, who used to head financial services and has quit 3 years ago. And today Ravi is very happy just playing tennis all across the world, writing poetry and teaching. So Ravi, over to you now.
For many years, looked at financial services, management consulting, helped set up banks, helped set up insurance companies, did a lot of work with the mutual fund industry. And then 3 years ago, I decided enough is enough. There's a very strong word in the English dictionary called enough. I have enough, I've had enough. And I decided that there are many other goals to pursue in life. So I'm teaching, I'm writing, playing tennis around the world. Last 4 years, I've gone to each one of the majors. That's the passion that you got to live with. Set up a studio, I'm doing some ceramic art. I'm going to start a course in architecture. So I'm going to go back to college and get a degree in architecture starting from this September. I publicly want to acknowledge here that I could not have done all of this stuff if I really didn't have some good financial advice. As much as financial advisors are castigated in public, hounded for whatever else, and I've had a financial advisor who's been with me for the past 15 years. I started investing 15 years ago in the mutual fund industry and, grew my portfolio from then. Never withdrew the money, including 2008. In fact, 2008 was a brilliant year to December to go out and buy a lot more of mutual funds. Because you knew that somewhere it would go back up. But one thing I used to always ask him is, I used to ask him, I hope you're making money from my portfolio. Because if you're not going to be successful, I can't imagine that you're going to make me successful, right? And I think that's one of the lessons that I want to, kind of discuss as I meet up with our panel. We have a very distinguished and how would I say, very diverse panel. These are all professionals from very different fields of the business. And you will find from them some interesting insights into what are their moods for investments, how did they make their first investment, what was the rationale for making that investment, was it safety, was it just some advice from some friend. So let me start by first calling Mr. Arif Zakaria. Arif, as a lot of you may know and must have seen him on television and in films, is a very well acknowledged auteur. Please come. Very well known and acknowledged auteur. He's been in the television business and the theatrical business for the past 20 years. Few years, as he says. Many films. Banaras, My Name is Khan, Haunted. And he's currently involved in a theater production of what is the name? Sorry.
Yeah, the place called Gardish Mein Tare, based on Guru Dutt's life. Essentially, we have performances throughout the year.
And Arif has also been involved with setting up 2 production houses. So he laughed when Anita introduced us as wealthy individuals. I think wealth is a very ill-defined term. But Arif, I just wanted to check with you, given your nature of your business, I mean, it's a very sporadic business, right?
Very seasonal.
Yeah. And I don't want to be undiplomatic in saying so, but there may be lean months and there may be some very strong months.
Lean years.
Yeah, okay, so lean years. So how do you manage the discipline of investment? I mean, do you do it as a regular habit, or do you say, okay, today I have a little bit of surplus and...
No, that's a good question. And in fact, when the season where I get money or get some sort of funding or get revenues, that's the time I sit and rack my brains and I try and invest in as many instruments as possible, as many avenues as possible, which will yield the maximum returns.
Okay.
And I'm a commerce student essentially, so I have a fair idea of how it works, very little idea of course. And it all starts, of course, with, if you ask me where I invest, as I speak to you, I have fixed deposits, which is the old grandmother's tale that you invest in a nationalized bank because our paisa government ko de rahe, it's not going to shut shop, they're going to run away with it. If they say they're giving you 9%, you'll probably get 9%, you won't get less. And then the last 15 years, I've diversified and parked a little bit of money in mutual funds, a little in real estate also. And I try and monitor these three areas very, very actively and very intensely as much as I can. And I've had a little disappointments with reference to mutual funds who I parked through a banking institution, which I won't name. And the advice they gave me, and then I realized in hindsight after 2 or 3 years that the advice was incorrect. And I actually stood to lose a lot of money rather than my investments being appreciated.
Right. So, Arif, since you talk about a bad experience with the bank, who do you use for advice? I mean, do you do some research on your own? I'm not sure if you have the time to do so.
A little bit of all, actually. I do research on my own. I take advice from wise family members, friends. Then, of course, you have these relationship managers which are allocated to you through institutions through which I invest. So I take advice from everyone, and then, of course, there's a lot of instinct involved when you invest.
Sure.
I don't know whether it makes sense.
Sure.
So like any business, like my business essentially works to a large extent on the instinctive comfort you form with your relationship manager or the person who's selling you or pitching a product. And if it caters to that instinct and I sort of feel that what figures are presented to me make sense, then I go ahead and park my funds there.
So you said a very important word, trust.
Yeah.
Have you been able to establish a working, trusting relationship with any of these advisors where you'll say, all right, I think you're transparent with me and I know what... Don't laugh.
No, you're right. Relationship managers are like girlfriends, they tend to keep more. So you tend to trust somebody and you sort of listen to that person for a year and a half or two, and then one fine morning you get a mail saying that, I've moved out from this institution and I've gone elsewhere. And then you're stuck, and then somebody else is appointed. Then it takes a couple of months to build your relationship and rapport with that particular person. And then, if you're lucky, that person survives, and even that person moves on. So, I mean, am I making sense here, or?
No, absolutely.
I've had that experience, honestly.
I would put it slightly differently because, every 6 months I get a call from somebody saying, I'm your new relationship manager and will you buy a life insurance policy? So, he's not very far off the mark.
But that's the nature of the game. I don't blame anyone for that. But yeah, what I would have liked is integrity and... see, ultimately you're dealing with humans, I know, and they're dealing with me. We're all humans dealing with each other. And I like a certain bit of integrity, a certain amount of trust which is built. And if I know the person is guiding me correctly through these adverse times, the seasons where we don't have money, then I tend to trust that person more, or that institution more, actually.
And what's been your experience? I mean, I know you work with bankers, you work with individuals. I'm not suggesting that you have a preference, but do you feel that given your history and given what you want to invest in the future, will you trust one type more than the other, or?
I would trust an individual more.
Okay.
I connect, I build a rapport. An individual who sells me financial services, gives me advice, I tend to lean towards that particular person, whoever he or she may be. Because there's a certain continuity. He doesn't speak from a certain platform of an institution. So there's a personalized touch which hopefully translates into something better for my investments.
Excellent. And have you ever, I mean, I'm just asking this because I I gave an example that I like to do it once in a while, but do you ever worry about the well-being of your advisor?
All the time. No, you do, because there's a lot of knowledge which that person shares with me, and he parks his experience also with me. So of course the well-being of that person is of paramount importance. So I do try and keep that person at ease. I don't ruffle him with too much of information. And being a novice, I know I tend to be demanding at times with my RMs and advisors. But I try and strike a balance and see whether I make sense in what I'm trying to say. And the demands I make, I try and be reasonable as much as I can.
And do you, for now we're looking 20 years into the future, have you made a preference known for how you want to do your retirement planning? If there is such a thing in your field, I don't think there is, but
I think I'll take all my money out and park it under my pillow and go to sleep.
Guys, I think you have a tough task ahead of you, because if he's going to do that, that's one customer lost to you.
No, as they say, there's a saying in English, the only way I can double my money is if I fold it. So essentially, no, I mean, I hope it becomes more transparent and more interesting for investors like me to park in funds in these various diverse, complex and simple instruments, really. And now, of course, we're living in great age of probity, transparency and some sort of censorship, which is very good. So when you're parking your fund in a private player, it's not going to be misused. There are regulators who are on top of that who will sort of see it. So in the next 10, 15 years, I'm hoping to continue in the same vein, meet more smarter, more intelligent, more integral people, and hopefully make more yields out of that.
And so final question is, if you met with the next relationship manager, this young kid, what advice would you give him? I mean, if he wants to build that, I know it's easy to say integrity.
Right.
He has targets.
Right.
He's getting a commission for a certain set of products. Where do you think you can help him in kind of reaching that middle ground?
I don't know. I see it depends on how the guy's trained and what his personal value systems are. I think at the end of the day, your personal value system plays a big part in how you sell a product, how you pitch your institution, and what exactly you're trying to say. So I'll cross my fingers and hope that he comes from a very sound stable and he gives me good advice. But there's nothing really I can do, because I know the pressures he or she also faces in selling particular instruments.
Yeah. So thank you very much, Arif. It's been a
Thank
pleasure.
you.
Thanks so much.
Thanks.
Good. Thank you. Okay. So that was one view of a professional in the services industry. I'd like to invite Dhaval Bharot. Dhaval is an executive director at Bharat Infrastructure Engineering, a real estate company. He's a civil engineer, studied in the US, worked in the US for many years. Please come, Dhaval. Domain knowledge is fundamentally for bidding for projects. And if you live in the western suburbs, I'm sure you've seen many projects that have been done by Dhaval and his company. So Dhaval, compared to all of us, you're fundamentally much younger. Okay. No, not very much. Just a little younger. Okay. So what's your view on investments? I mean, have you started investing, or are you, because you're in the real estate business, do you think that's the way to go? I mean, what's your take now? I mean, are you looking at diversification? Are you investing in some other instruments?
Being in real estate.
Sorry, I think you may want to take the mic.
Being in real estate business, that's been the prime area of investment. So whenever there is an opportunity to make an investment, it's always been into real estate. Because I believe since we are there from the beginning, we know the knowledge of where you can make more money compared to a mutual fund or any other investment. In fact, we are looking for other investors, and make them that we can double their money more than probably a mutual fund. So we are their competitors in a way.
So guys, I think you have a problem on your hands, which is you have a competitor here rather than somebody who's going to give you advice.
Yeah, see?
See, there you go.
We can be here all day.
Okay. So, sorry, please go ahead.
So that's been, as far as I'm concerned myself personally, that's where I've been investing my own money.
But have you had people come and tell you, look, it makes sense for you to diversify your risk and diversify your portfolio? What if there is a real estate crash? What's your take on that? Have you had somebody ever come and try and give you that advice?
Personally, yes, there have been a lot of banks whom we deal with, on debt funding and other things. They've been saying you should keep parking a little bit of fund in the other areas as well.
Right.
We've been listening. We tried one, and as Arif mentioned, I had a very nice experience with them. And yeah, I mean, I don't know now. In fact, I'm tracing them. That I've moved closer to your office and your location, so maybe you can help me what to do with the funds.
Okay.
And I still can't find him. So he says, now I moved to some other place in city. Maybe I'll connect you with some gentleman in my other office.
So I'm sorry.
There have been problems with.
Yeah. So this is not a practice speech. So just in case some of you take offense, I guess it's meant. Yeah. So just going back in terms of while you invest in real estate and you've got some other investments, what about things like looking at the opportunities that you'll get out of for corpus that you'll build up for the future for your for your kids, and is it just life insurance? What else have you looked at?
I'll tell you honestly, like parents have always, they've been traditional, they've been looked into LIC policies, so that's where they've kept investing and, thought of the future for my kids and everything else. But as far as I'm concerned, I'm willing to take risk at this age. So I'd rather park into some real estate. Sometimes it could not be a great return. Sometimes it's much more than the return which I've expected. So I like to play that risk right now at this stage of my life.
And since you worked with the banks in the past, and I asked Arif the same question, what is it that you've looked for, and what have you been able to trust in case of the advice that you've taken?
I think the consistency. I mean, they have, when they come, they pitch, they sell it. Of course, like how we sell products, they sell it very well. But the after sales, the guy disappears in a year, and then there is another manager, and then nobody even speaks about what your investment has grown up to. I have put in some money with one of the banks. Must be very little money. It's been about 5 years now. They've never called me after the first investment. Maybe 1 year they were tracing me till I had to pay the second installment. And after that, I've had nobody calling me.
Right.
Now I've tried to reach them that, yaar, kuch hua hai kya us fund ka, I can do something with that. So I failed that.
And in terms of going forward, do you continue to see yourself purely playing the real estate market? Do you expect that if the opportunities that will emerge, will you look at them? I mean, how do you see your investment future?
So far, I think it'll be a real estate only.
Okay.
Because that's it. Till I'm in real estate, I'll stick to this.
I'm giving you guys a challenge. Okay, so you have a extremely partly dissatisfied client. You'll hear me use the word client because I think it's disservice to call us customers. Customers are a transaction business. I hope you see us as clients somewhere you can build a relationship with. So you see a dissatisfied client, partly with the relationship that he's had in the past, but you also see an opportunity, and as the gentleman in the front had said, that we can convince you that there is better ways of investing that money, and I hope that you will obviously try and, while he's here, I'm not sure how long he's here, but I hope one of you will try and make an attempt to at least convince him to have a discussion on the topic. I don't want to become a boxing match, but I'm sure he has his reasons and you have yours. But it's been a pleasure. Thank you very much.
Thank you.
And look forward to seeing you.
Thank you.
Thank you very much. Okay. Faisal Farooqi is up next. Faisal is a modern, what I would say, a modern day entrepreneur. He runs a company called mouthshut.com. Many of you must have heard of him or seen his advertisements on television and on buses and on taxis and everything else. Being in the modern entrepreneurial mold and being young gives a very different perspective on what young India is looking for in terms of investment. So I thought it was a good opportunity for us to get Faisal's views. You're young, and I'm sure you have a very nice spending pattern. But are you starting to invest?
It's a privilege to be here among people who are looking to invest. I apologize. I'm the person who spends. And one of the things that I have realized is that money is not something that you can keep. You got to make use of money. A friend of mine, if you feel I'm young, thanks for the compliment, then somebody really younger than me just sold his company to Snapdeal for $400 million. I don't know how many bankers and private banking relationship managers are chasing him, But that's the kind of money you will see in this country because we are moving from a nation of being a shopkeeper to a nation of entrepreneurs. And a shopkeeper just builds wealth for himself, an entrepreneur builds wealth for everybody associated with the ecosystem. So with that, I want to say yes, we invest. As entrepreneurs, we really invest. We invest in knowledge. We invest in ventures, which may be risky. And personally, if you ask me, and I know a lot of entrepreneurs who are CEOs of well-known companies in India that many of you have heard, as well as not so well-known. We invest at various levels, but we don't invest in banks, which means we don't believe in fixed deposits. We don't believe in saving accounts. Is there anybody in this room, raise your hands, who has made his client super rich by making him park his money in fixed deposit?
You won't see a hand on this one. Wrong industry.
So we don't do that. We take big bets. Recently, a group of us, we've invested 26% in a supply chain, agriculture supply chain management company. It was a huge investment for 26%, but within 2 years, if the investment works, I think the returns will be 20x. Those are bets that we make. Those are knowledge that we are betting on. And you have these options now in the form of angel funds, venture capital funds, private equity funds, which are mushrooming everywhere. Personally, I would like to see a relationship manager who understands all these. I had a relationship manager in a bank that has 150 years of history in this country. It's called Standard Chartered Bank. Anybody from Standard Chartered? He served me well with banking for 2 years. Two years later, I started getting calls and emails from Birla Sun Life. Anybody here? I did not give that email address to anybody else. So the only way Birla Sun Life started poaching me is because somebody at Standard Chartered may have compromised with my data. Now, that's another story. I escalated that issue at the highest level in Standard Chartered, and I got apologies from the headquarters. I think some people were fired also for leaking that. But that is Arif's story, that relationship managers change. One fine morning, they are so inclined to sell you Standard Chartered. The next fine morning for them, and their pitch to you is Birla Sun Life is the best thing on earth. There I have a problem. I have a problem of transparency because I see through these things. I invest in knowledge. I will respect that you accept my knowledge of your fund because the internet is making everything so transparent. I will not believe if you're telling me this term life is better than that term life because policybazaar.com has made everything transparent. So the private banking group of banks, when you hire those MBAs, make sure that they are transparent and aware that the consumer today has access to a lot of knowledge, sir.
Yeah. So, given your experience, and I'm assuming that, you know, like you said, you're a risk taker, you're investing in a whole bunch of other instruments, etc., and you're not technically looking at a safety net. You know,
Not at this stage.
Not at this stage, but somewhere down the line you will.
Yes.
And I'm just kind of putting a hypothetical situation in front of you, is that are you going to try and do this on your own because you will be more empowered, you will have better knowledge, or will you seek professional advice?
I think professional advice will always be there. I think there is no substitute for professional advice. With all the internet and all the transparency, I think professional advice will always have its role to play. The only difference will be that the professionals have to be more knowledgeable than the consumer. The bar was here, the bar has to be here.
Yep.
You know, just 6 months out of college and just memorizing all the mutual funds in the market will not help you sell to entrepreneurs like me. You really need to understand, you know, what are the different types of mutual funds out there. Because I will have more questions that you probably have ever faced in your career if you're trying to sell to me. And that is how I will differentiate you, and I will value your advice if obviously you've proven me right.
Yeah.
Instead of selling me term life, for example, somebody who's newly married. We are a nation that did not believe in insurance. We are trying to build a nation. Yesterday I was sitting with the finance secretary and he was telling me that how insurance is still not very, very big market as they had anticipated. I spent a whole day talking to him about how to grow this whole thing in India. As a nation, our insurance is our kids. For people who have had kids and they are older, you probably invested in them so that they will take care of you. We did not follow the Western model or to each his own. So I need to buy my insurance. So I'm going to follow the same because at the end of the day, I'm still that same Indian that my parents were. So I will invest in my children. So I'm looking at products that will help me cover their cost of education, especially international education and professional education, which is so expensive now. So I'm looking at 18 years down the line, I may need 50 lakhs per annum for my kids. Do you have a product that serves that? If you don't have it, then don't sell me term life because pretty much I'm okay. I don't know when I'll die, nobody knows, but sell me something where I can invest so that at 18 years of age, my daughter can afford, if she wants to go to Harvard University, she should not have to beg, borrow, or steal. She should be able to pay off from that policy that I invested in for 18 years.
So Faisal, just as a question, I mean, how many of your, or how many interactions have you had with your advisors where they have actually listened to what you need and then try to figure out something that they could position for you that met your needs?
You know, honestly, it's a very good question. I think we all know the answers. They're only selling products that they know. And you guys, I think you identified the fundamental problem that plagues the industry, the relationship advisory, transaction advisory industry. It is all about relationship managers, private banking clients not understanding customers. They are only pushing a product that they already have without understanding. One of my cousin, another big bank, international bank, was trying to sell him real estate in Dubai. He's like, invest in Dubai. The guy has absolutely no interest outside India. I don't think his kids have any interest outside India. I don't think he will ever live in any other country outside India. Why are you selling him Dubai? Just because there is some new development that's coming up in Dubai. So try and understand what the client's value system, as somebody said, the value systems are. Aspirations, future aspirations. Don't sell him just because some Soba developer's property in Dubai is taking off and you have a mandate to sell for 59 apartments. Don't do that. Don't push. Understand.
Very good. So, Faisal, thank you very much.
Thank you.
It's been good insights. Two messages I think you have to take from him. This is the new generation. These are the guys who are going to be making serious money. One is, of course, he will invest that money into other risky places. I mean, he will build other businesses. But I'm guaranteeing you that there are opportunities for you to be able to reach out to people like him, understand what he's looking for. He's worrying about his kids' education. He will worry about, 20 years from now, all right, I've reached a certain stage. Now how do I protect some part of it, create a legacy, estate planning, and I'm just giving you a small insight. The reason that I stuck to my wealth advisory, to my wealth advisor is that the first thing they offered me was, we'll help you figure out a very tax-efficient way of putting a will together that will create a trust for your kids. Okay, and I thought to myself, that's unique. Okay, so I've got some money and I don't know how, what will be the tax implications, and it's a morbid subject, but who else will take care of it? Banks wouldn't understand this. It has to be a wealth advisor. And therefore, technically, it's a very good entry point. And, like he says, he will worry about the future somewhere down the line. And I think
you rightly said, we need wealth advisors who also understand tax planning and not just pushing a product. I think the new generation, I'm sure the older generation did, but the new generation, the people in 20s and 30s believe a lot in giving. I know that my community of entrepreneurs, we give a lot. Some of us make noise about it, some of us do it quietly, but we give a lot in charity, in CSR, in Section 25 companies. And none of the products that relationship managers sell have any component to charity, giving, Section 25, tax planning, etc. So you're absolutely right about it.
Great. Thanks,
Thank you.
Faisal. Thank you very much for your time. Good seeing you. Okay, and my last guest today is Mr. Jayant Vaidya. And you know, unlike, just as a contrast from Faisal, Mr. Vaidya has been in the real estate and architectural business for the past 30 years. One of the oldest architecture firms in the city. Please, sir. And you know, so I was just having lunch with Mr. Vaidya, and I told him I'll have no choice but to introduce you as an enemy of the audience. Why? Because he's a complete believer in investing in real estate. He understands that business really well. So you have two potential targets here who are investors in real estate who think everything else really doesn't give them the result that they expect in terms of the investments. So, Mr. Vaidya, thank you very much for making your time. Just as a starting point, I mean, going back in history, how did you start investing? I mean, standard FDs, Unit 64s? I think you'll have to use that mic.
I think I started from the scratch. So in the initial stages, the investment was just out of question. But later on, as I started got into the practice and to the professional mode, and I started understanding my subject of real estate and architectural practice in details. Then, obviously, initial the FDs, then a little bit in government securities, post office savings. That was the initial.
PPF.
The PPFs, yes.
Yeah.
This was the initial way.
So when did you start diversifying and into what? I know that real estate, of course, becomes your...
Real estate, just as maybe a couple of years passed down the line, I started practicing in 1976 when real estate was, the cost of real estate was very low or very cheap. But subsequently, as the things started moving and I started understanding my subject, then I knew that there is a lot of potential in the real estate sector. A certain amount of my professional earnings and everything, I put around, let's say, 10 or 15% or 20% to this rest of the things. But then as I got into the real estate sector, then I knew that it was paying me much more than anything else.
Right. Well, you did mention that you've diversified into mutual funds and you've got other products, etc. How did you come about that? I mean, did you decide
This generally happened through my chartered accountants, because basically it's, I'm not from the finance sector. I'm not too good at it also. And then basically one-to-one integrity, one-to-one knowledge of the person, you believe in somebody, you trust in somebody, and that's what I have been doing. And generally, whom I have stuck with right from the beginning, or with the chartered accountant, they have been helping me with this.
Right. And does the chartered accountant that you work with, does he give you overarching advice? I mean, does he support you with obviously from the taxation side, but also from your real estate portfolio side, or just?
No, so far as that limited amounts are concerned, he keeps on guiding me. But so far as the real estates are concerned, I don't need his guidance. Rather, I could be a guide.
Very true, very true. So in the investments that you have made, whether it's mutual funds or insurance, etc., nobody else has ever approached you, your bankers or?
Generally, it goes through the chartered accountants. Okay. He brings them to me.
Right.
He talks to them.
And so anybody else is automatically dismissing. I'm already taken care of.
Yes.
Okay. What about things like your succession planning and, you're planning for, the future and retirement corpus and?
I think I'm already on the verge of retirement, so, as it is also. And I'm comfortable with the real estate investments that I've done all through.
As I told Arif, actors and architects never retire. So,
yeah, that's true. I don't think I would retire. I've crossed 65. And I'm very much into my business. I'm very much deeply involved in real estate. And since I know my subject too well, I know which sector of the real investment is going to pay me back much better than any other investments that I do.
So you guys, you have a second challenge now. You have skeptics amongst the, amongst the panel here, who consistently believe that their investment models, their investment instruments are significantly better than anything that you can offer. I would again strongly urge that if you have a little bit of time, spend 10 minutes with Mr. Vaidya before he leaves and with Dhaval, just to try and see their point of view. I can guarantee what will happen is that if you try and position a certain set of returns for them, not by just looking at the product, but understanding what their needs are and where they have consistently stayed away from you, all of you, you will find that there's a very large chunk of disbelieving clients, and which is what I think everybody is out to try and target.
One thing is that when you are in real estate sector, there will be a lot of people around who must have had heavy losses, small losses, and must have faced difficulties in that wherever they are invested in the real estate sector. Just as Dhaval said, if he is from the real estate sector and if he is a developer, he will need all the funds that he has for purchasing of land. Land is a very essential commodity for building industry. And for building industry, now so far as the city of Bombay is concerned, which is where I am actually practicing, then once you don't have the land component, then it becomes, obviously you get into different mode of construction, that is the redevelopment mode and everything. But then all the monies that you have are required to be plowed into it, and if it's your own business, just as the one is doing, then you definitely know what you're going to get out of it. And for that, according to me, or what I have been investing is only because of thorough knowledge of the real estate and thorough knowledge of my profession, that is architecture profession. I've been the head of that architectural organization in 1999 to 2001, and I've been on the top of the, in the committee from 1988. So whatever the new rules, regulations government makes, the municipal corporation makes, the central government makes, that we are into discussion with them at all stages. And there are a couple of things that are going, which are going against. Maybe a couple of years back, the unethical issues started cropping up, and we were on the forefront trying to stop the unethical issues.
So, sir, do you ever, I mean, I know all of us sitting in this room sometimes worry about the real estate bubble. Do you worry about that? Does it keep you up at night?
Yeah, you got to be careful about where you are going to invest. Now, real estate, affordable housing, according to me, is not possible in Mumbai for the lower middle class and even partly for the upper middle class. So automatically you start stretching out of the city limits.
Right. So, sir, thank you very much. Appreciate your time. Like I said, gentlemen and ladies, we have a couple of people that you should be out there talking to. In fact, all the four guests that we had have expressed, thank you, sir. Thank you very much. Have expressed a set of opinions. I don't think we wanted to sugarcoat them, so some of them have been uncharitable, and I suppose that goes as the game goes. But it also kind of gives you a very good idea that this whole business of advisory is not really well at the moment. If you take the gaps that are between individuals who can only represent a certain fund or a certain business, don't have enough technology as a platform, or if you look at the banks whose relationship managers do tend to drift off every so often or get transferred, and therefore you are left with the next person trying to explain to them what your expectations are. Or the advisory firms who I think are in a good position to look at this but have not invested enough in a technology platform or in an outreach program or in training. So there are enough gaps for us to cover from an industry perspective. The last thing, of course, is that everybody has said that, look, please don't come and push products at us, not at this segment at least. It may work in certain other segments, but in this segment especially, understand what we're looking for and then position the right thing for us, because we are getting a little smarter than what you thought we were. So thank you very much for your attention and time. I appreciate it. Thank you to all the guests. Thank you. Thank you so much for the wonderful.
Just stay back for a couple of minutes. Faisal talked about P, VC, and you said you were looking for such propositions, okay? And Mr. Vaidya talked about his preference for real estate, and so did Dhaval, right? So I urge you to stay back, because our next session is going to be on something called alternative assets. So we will have experts in this particular area. So now let me invite the moderator of this session first. The moderator is Umang Papnija. He's the CIO of IIFL. Umang? Okay. Okay. I think then let me invite Ashish Somaya. Okay. Okay. I think they're all confabulating and working out the discussion flow and all that. So it's very clear that alternative assets form an important and integral part of the package that wealth managers today need to offer to wealthy clients. And this was very clearly evident when 3 of the 4 participants did point out that they were not being offered the right kind of products which were more in keeping with their expertise and their expectations. So this is exactly why we thought we will get these 4 experts to talk about it. Essentially what we have done is we've got a representative of each of the broader categories of alternative assets. So we will have someone representing the VC stroke PE space. We will have someone from the real estate space. We will have someone representing what we call absolute return funds. So I think they're all here now. So Radhika, are you kitted? So come, why don't I start with you? So I'm happy to invite Radhika on stage. Radhika works with Forefront, which is now an Edelweiss company. Radhika has been with AQR before she founded Forefront, and she has earlier worked with McKinsey in the US. Let's welcome Radhika with a round of applause. Okay. Umang, you done? Yes. Okay. So Umang Papnija. Umang is a CIO with IIFL. So let me invite him, and he's going to be leading and moderating this session. Thank you. So, Anand, are you done? So, hey, come, welcome here. So Anand is your friend Faisal. So we brought him here precisely because we did not want clients like you to be left. So Anand, what I liked, I went to your website, and this is the first time that I've seen any B2B person make a business out of a website. Seriously, all the B2B people, folks, generally have what I call a corporate brochure as a website, masquerading it. His is the only website which is actually, the second you hit it, it says, let's talk business. This is what I can do for you. Are you ready to do this for me? I love that about your website.
Yeah, I wrote it myself, actually.
Oh, great. That's fantastic to know. So Anand has been with Seed Fund earlier and has invested in many companies. So welcome, Anand. So all of you must check out his website. It's called indiaquotient.in. Even when we are running consumer-facing businesses, our websites don't invite anyone or give anyone reason to do any business with us. But here is a person who's running a VC fund, and we thought these people were really not consumer-facing and they had nothing to do, but you go to his website and you will understand how anyone who's looking to get funding can start a conversation with him right there and then. And do it not just as an exploratory thing. There's a lot of filters which apply, and you can straight away cut across stages and start a discussion with them. So I love that about your website. Shahzad, may I invite you? Shahzad is one of the most experienced persons in the PMS and alternative asset space. He's with Reliance. He heads the business. And welcome. And he has experience across categories, equity, real estate. So here's your man. And finally, let me invite Ashish Somaya. Ashish Somaya is the MD and CEO of Motilal Oswal, one of the youngest but one of the most admired CEOs in the business. He is the only CEO I know of who has a fan following among distributors. I've heard of fund managers having fan following, but this is the first time I've heard of her. And I know that for a fact because I attend a lot of conferences at which Ashish speaks. And I'm a part of a couple of WhatsApp groups of which Ashish is also a part. The only person and who comes in for any degree of praise is Ashish Somaya. And even when he's not being goody-goody, he's not being nice to them, he's giving them negative feedback, and he's telling them this is what you guys need to do, but he's admired for it. So welcome. Okay, Umang, I'll leave it to you now. A couple of mics may not work, so here's your.
Am I audible? Hello? Yeah. Okay, thank you, Prem, for the warm introduction to all of us. So we are here to actually discuss alternative asset classes. So I've got a very distinguished panel with me. We've got Radhika, as Prem already mentioned, but Radhika is actually representing the absolute return space. Anand's representing the angel VC space. We've got Shahzad, who can actually do the whole panel, but at the moment he's doing only real estate in this panel, but we can always dig in and check his views on public markets as well. And we've got Ashish, who's basically representing us. Now, when I say us, what have we done so far? We've done only conventional stocks, bonds, cash. So he's basically going to compare all these asset classes and tell about the pros and cons of long-only investing, normal bonds, etc. So he's going to take that role on the panel. So I'll start with Anand. Anand, so I'm sorry we got a little delayed because we were talking about entrepreneurship and Anand was giving his views. So I'll start with Anand. Anand, so unfortunately in the wealth management industry we've not had very good experiences with private equity, if I can say. I don't think the industry has done much of angel investing. But we've not had very good experiences in the past with private equity growth style. What do you think now when this space is coming in? What are your views? What exactly is changing, and how should investors now look at this asset class?
See, even globally, venture capital as an asset class is very top heavy. There are probably 40, 50 good companies, for example, that do well every year globally, not just in India. Even in India, for example, there will be 20 good deals probably floating around, maybe 30 in a good year. And the best VCs, the top VCs, have access to all these deals, right? Even at the early stage, the smartest entrepreneur, for example, if one of you became an entrepreneur, your first thing is, okay, let me find out, do research, who is the best investor to go for, right? So the best entrepreneurs typically will seek the best VCs, and hence the industry sort of becomes very top heavy. So the difference in returns between the top 10% of the funds and the bottom half of the funds in terms of ranking is significantly high. And which is why, this is not an industry where you can sort of chase, spread money across 5 funds or, it's important to get into the top funds. And the way to evaluate top funds is, do they have the access to best deals or not? Unfortunately, in India, there are very few homegrown funds which are India-based, where Indian investors can participate in. Today's top funds, for example, are Sequoia and Excel in India. They don't take Indian money at all. So to that extent, again, the access to Indian investors to top class funds is limited. And now, recently, we have very few funds emerging, and we are trying to perform. But if you really look for real top funds, very few, and which is why it is important for investors to sort of build small, early relationships. Today, I know a lot of people. Anand, I want to give you $500,000, $1 million, but you know what? Can you put me in touch with Sequoia? I want to put $10 million in Sequoia. I'm saying, like, Sequoia doesn't take anybody's money. They don't take any individual's money, whether Indian or not. So I think, yeah, it's a very top focused market,
right.
And to that extent, fund sizes limit how much money they can move and how much money or allocation can a normal HNI get for investing.
Perfect. So we'll come to the landscape change in entrepreneurship later, but let me move on to Radhika. Radhika, so you are into an interesting asset class, absolute returns, and of course, Edelweiss also bought you over just to complement their things. But how do you see the investor interest, or do they understand risk-adjusted returns in terms of a product? So, for example, if market is up 60-70% and you're running a long short and you give 30%, will the investor appreciate that?
See, our asset class is, in comparison to the other three panelists, our asset class in our industry is very new and relatively small. So this has really been a story of investor education. If you look at what all of us spend our time doing, it's really about finding the right investor and setting the right expectations. So to your point, yes, if the market is up 67 and you're up 35, investors should be happy, and that's something that one tries to impress upon more and more. What we do find is after 2008 and after 2011, there is some understanding of risk-adjusted returns. It may not be a technical global risk-adjusted understanding, but the kind of things that people understand are, okay, maybe 1/3 the downside of the Nifty, half the downside of the Nifty, maybe you won't lose capital in this. So in more simplified language, yes, people are beginning to understand and value risk-adjusted returns. We have quite a bit of space and education to go, and there's a lot of focus on finding the right client for the strategy. But yes, that understanding and appreciation is improving, particularly in markets like the 6 months, which have been very, very choppy.
Choppy, yeah. So what kind of products should you expect in this space? So what kind of, not only your firm, but the industry in general?
What the industry is endeavoring to do in its early days, and you have to understand we have just equities as an asset class to play with. Globally, when one looks at absolute return funds, you are open to equities, currencies, commodities, fixed income. It's a much more open basket. Today, what we have on our platter as an industry is equities. So people are endeavoring in their own ways to deliver products which will give you equity participation broadly with less risk than the market. Some of it will be around long short trading, some of it will be around special situations trading, some of it will be around technical trading. Everyone will have their own individual style, similar to how mutual fund managers or long only managers have their own style. But this is essentially what people are endeavoring to deliver today.
Good. So I'll move on to Shehzad. Shehzad, I recently read a report, a very large institutional brokerage. They said there are 25 crore households in India and there are 30 crore houses. Now with this background, what do you think real estate as an asset class is going to do over the next few years?
See, if I was to talk of, in the real estate space, and now I speak as an investor, who invests from a financial perspective. So there's financial money which we aggregate from investors and put into that space. There are many, many sort of different slivers of the market you could play. You could play, for example, equity in the real estate space, which is you go, you take land, you take a punt on that and see how it goes, right? You could get a lot of upside, you might not. You could do at the other extreme debt. You could do now what would happen REITs. So you could play different spaces, and your risk-return spectrum completely varies across the entire spectrum. So you could play something from highly, let us say, highly potentially great returns in higher risk, or something which is relatively low return with low risk with reasonably good return, or lower risk with reasonably good return. So you have that entire spectrum you can play out in. Our sense is that today most of the market is... Sorry, I imagine that means I wasn't audible. So maybe I've got to just quickly start. All I was saying was in the real estate space, you could play many different, there's no one homogeneous space. Actually, in the entire alternate investment space, it's not homogeneous. It's different strategies, different sub-segments you could play. In the real estate space, you could play again different things. You could play equity, you could play debt. Most of what is played in the market today is primarily debt, which is relatively lower risk. You're primarily playing execution and sales velocity. So our sense is, if you look at, let's put it this way. Now your question was, of course, what is the outlook for the real estate sector? And my sense leave the shorter term, but like we just say in the stock market, if you do believe that India will grow at a fairly healthy GDP growth, if we do believe that, there will be a lot more make in India, there will be a lot more job creation, there will be a lot more else, we'll all get fatter bonuses, our clients will become a lot more richer, then obviously there's going to be a lot more demand for houses, right? And so I guess over a period of time, the demand for houses, either primarily from a perspective of self-use, to investments should continue to be strong, notwithstanding certain glitches. Certain markets you would have difficulties. You could take prolonged periods to work the excess supply out of, certain maybe less. But the important point from an investment perspective, I just want to say there are, every bad market, every difficult market also gives you opportunities. There are different ways you could play it. Debt mezz, which sort of mitigates your returns, which is primarily where the market is today. Or you could play a more aggressive game. So there's a lot there, but net, I think the outlook over a longer term is fairly positive, notwithstanding near-term hiccups.
So you've heard the three panelists, got to know a little bit about the REACH asset class now. As I said, you're representing us. So what are your initial thoughts on the conversation?
I think on the mic. Okay. Few things, from the audience perspective. I think that, so we are in a country basically where one thing I track is if you look at equity as a market cap, what is the public holding? I mean, broadly there are four categories. Look at promoter, FII, DII, and NPNI, non-promoter, non-institution, that's retail. So out of 100 lakh crores, we are anywhere between 10 to 12 lakh crores of individual holding in equities. Now, in the full market, we are 10 to 12 lakh crores or 10 to 12%, but in Nifty, we are below 4%. Okay. So we have this humongous equity holding, and for lack of any other word, most of it relatively in junk. We have about 80-85 lakh crores of bank deposits, and then you add so many other things. So you're basically in a country where there is over 100 lakh crores of fixed income, say 12 to 15 lakh crores of direct equity holding, 3 lakh crores of equity mutual funds. So from that perspective, there is obviously alternates will tend to be something which is focused at the creamy layer or the top end of the market. And there is this bunch of people who've lived through equity for the last 12 to 15 years. They've seen various cycles. So obviously they need to, some of them may be having good experiences, some of them may be having bad experiences. So obviously they need to experiment with, risk mitigated kind of products. Obviously there is the top end of the market where there are people who desire higher returns. So the point is that India is in that sense very complex. So, there is a space at literally every strata of the market. And at the same time, at every level, there are people, there are people who haven't experienced a professionally managed product yet, bulk of the people. And, they've been floating here and there with all kinds of experiments. So
generally what basically you're saying is that there's a huge section of the population which have still not seen conventional products yet. So alternatives might be a little early. That's what the point is?
So what I'm saying is that it's not early in that sense. India is complex. So why I said from the perspective of the audience out here, their job is in that sense challenging because the profiling has to be like really sharp. If a guy who has made a huge amount of money in equity and you say like Radhika was saying, he'll say index is 70% up and you're giving me 35%. at exactly that convenient point in time, he'll forget what she did for him when the market was going nowhere. So there is this entire evolution related issue, and there are all kinds of clients. So I think from a distributor's perspective, the job becomes very, very complicated to pitch the right thing at the right place. So that evolution is clearly one challenge. The second thing is that, professional management, irrespective of whether it is alternate or otherwise, the appreciation of professional management itself is lacking totally.
Perfect. Okay, so we'll come back to that, but let me
When I said appreciation, I meant understanding of. I'm not saying that we are not appreciated in that sense.
So going back to Anand, so I just had for the fortune of having coffee with Anand probably 2-3 weeks ago. The only thing which happened after the meeting was I had lesser space on my mobile because I had downloaded so many apps which Anand suggested to me, and also made me feel old because I thought I had a lot of apps on my phone, but I possibly got to know some more of them. But the point is, Anand, there's so many angel funds only concentrating on technology. So when you hear about Sequoia or we hear about you or the others in the space, what is this obsession about technology, and are there any risks?
No, I think technology is how we try to describe ourselves to sort of act behind the walls. Now, I'll just give one example of, and we were discussing just now about this very interesting company called Paras Pharma. I'm sure you guys have all heard about it, right? Two things that happened there. One, of course, whenever you have to choose between betting on an Indian entrepreneur and MNC, it's a very easy choice, right? I'm sure many of you made money by being the Indian entrepreneur challenging MNC. Move was a product, it was a painkiller tube which was competing against Iodex. Iodex, when I was a small kid, Iodex was the de rigueur, in every household, right? And Move was a simple product. Move completely erased, So Radhika said she's not been in India for a while, and she doesn't know what Iodex is, right? It's just Move. My son has no clue about what Iodex is, right? And he'll probably never find out. So what happened was that underlying small technology, of course, the understanding that Indian entrepreneur had of Iodex will soil your clothes, for example, all of that, was there was a packaging technology change. So my father has a plastics business also, which was a soft squeeze tubes that entered India around 20 years ago. Mood was one of the first products which was using those soft squeeze tubes, right? While Iodex was still sold in glass bottles with a metal cap, right? It's a very small underlying technology change, because that kind of packaging for soft tubes, if you guys remember, even Colgate toothpaste 30 years ago was sold in a tin tube, right? And then eventually at some point in time they changed it to a plastic tube with a tin coating and blah, blah, right? So these things became available, and companies like Move were the first to move fast along with, the other thing that Move did was to come out with a very emotional campaign, right? Only in a country like India, an emotional campaign around somebody else applying a pain balm to you would work, because you go to America, it's very rare. Nobody applies pain balm to you. Right? Here it's a family affair, right? 3 people will wait on you while your headache goes away or your backache goes away, right? They build a campaign around it, and if I really see, there might probably was a little bit of technology under it, right? So I think the best funds today, they are betting on a consumer boom, a very large consumer market, and a little bit of underlying technology, let's say, or so for us, for example, the underlying technology is that everybody has a cell phone. Now, did I play any role? Nothing, right? I was a BlackBerry lover for the longest time, till I was told by my entrepreneur, sir, aap ye BlackBerry chodo, Android lo, nahi to nahi hoga, right? So I bought an Android phone because my entrepreneur insisted that you have to have an Android. But the fact is that today, the best companies, for example, WhatsApp, right? It's not a mobile phone manufacturer. They are simply leveraging an underlying technology, which is everybody has a smartphone. And then people will now leverage WhatsApp. Now everybody is using WhatsApp, without knowing what is Google search. I ask a lot of people, you using WhatsApp, do you know what is Google search? Do you know you can find out things on Google search? No. But you are using internet already, right? No, that's fine. Do you have an email ID? No. But you have an Android phone, you have to have an email ID. No, that somebody created an email ID for me. So there are people in India who don't have an email ID, who don't know what Google search is, probably also don't know what a Play Store is, right? But they all actually are using internet, right? Now this is the trend. Now somebody has to make money on top of this trend, right? Unfortunately, as of now, we don't have Make in India technology anywhere. So if somebody comes and tells you, I invest in technology companies in India, we don't really have core technology in India anywhere, right? Indians like, for example, Case King, I was just reading the story. Now, absolutely no doubt that only an Indian can sell hair oil to Indians, right? I mean, it can't be a MNC pharma company, right? So, whatever they did was phenomenal, right? And any day, I invest in a hair oil company any day than a technology company. So I think the best investments are consumer businesses, run by really very good entrepreneurs with some underlying technology, shifting the market, creating a new market somewhere. So, did I answer one?
Yeah, so but still not convinced. So I'll actually read out a tweet, which went viral a few days ago. I'll read it out. So I just opened it. It said, ordered lunch through Tiny Owl. Okay. Paid bill of 155 via Paytm. Okay. Got cashback of 77 bucks from Paytm and 150 from Tiny Owl. So I earned 72 for having lunch.
Right. Yeah. I should not be answering for that investor. Come on. So, see, what's happening is.
No, the point is.
I get your question.
Is this a sustainable model?
Yeah, is it sustainable or not, right?
Yeah.
Is it capital efficient? Is Flipkart capital efficient or not?
Yeah.
One benchmark I want to do is, Flipkart was all about discounts, right? I just ordered 4 small games for kids because my sister is coming from US and I had to buy things for kids. Each one of them had a courier fee of 60 rupees, 80 rupees and 100 rupees. I'm ordering a game for 300 rupees. They're charging me a delivery fee of 100 rupees. Okay, no longer free delivery. The total order size actually exceeded 1500 rupees and yet I paid around 300 rupees just for delivery fee. Okay? I think these discounts are a way of buying market, okay, market share. Now you can buy market share by advertising. While I know Kishore Bihani doesn't like, I hope there's nobody from there, doesn't like discounting anymore, but the entire chain was built around discounting and nothing else, right? Walmart did discounting crazily, like every company has 1 or 2 discounting Trojan horses. If you think everything on Tiny Owl is free or everything on Flipkart is free, that's not true. Is there a little bit of an advantage? Yes, in fact, I think there are now maximum sales on Flipkart happens on Flipkart only items, right? I mean, Xiaomi, what's the discount? There's no discount. Because Xiaomi phone is, by the way, selling only on Flipkart, right? Yeah. So I think that's where the market is going. Now, we can always debate whether that's the right way to gain market share, or is it fair or not. I think the country definitely needs a competition commission, for sure. But besides that, it's all fair. I mean, it's legal, and everybody is allowed to gain market share. So
correct. I'll add my bit to that. They say when the service is free, you are the product. So hopefully you'll remember that next time when you download anything. Shadab, coming back to you, this debt fund, so real estate debt, this category. So I used to remember in 2009-10, I used to read comments saying that these are the type of products we don't do at all for our clients. So that used to be the normal quote of head of wealth management, individuals. Now the same banks and the same institutions are selling real estate debt. So what has changed?
I guess I can't specifically maybe answer on behalf of some of those guys.
Yeah. No, but it's an industry phenomenon. Everybody's selling it, so we can't really run away from that. Right?
So, but I guess what's happened is that like any industry, I think people need to see proof of concepts. Maybe some people started this in 2009, 2010. You had it move on, you see it work, you've seen people get their money back, people more confident, and you've started to have anything from single NCDs sold to debt funds sold and so on and so forth. Also, what worked along the way, there was a point in time in India which you would recollect, which was sort of twilight zone, where you could either invest in liquid funds or you could do real estate. There was nothing else you could invest in because you wouldn't be buying debt because interest rates were at that point in time rising, and equity was at that point in time, may have been a great time to buy listed equity, but not too many people were buying it. So maybe that's when a lot of it also got prominence. And since then it's become, if I can't use the word mainstream or staple, but it's at least become a reasonably meaningful part of most wealth managers' sort of portfolio. I suspect it would stay there unless you see some sort of an implosion. I'm not saying it would ever be the largest part of the portfolio. I don't think it can be or should be, but it would be a significant part of the portfolio. Until you have, I guess, one of the things in the investment management business in general, more particularly in the space we occupy, is that you should make no mistakes, or you should make less mistakes, because a mistake can send the industry back as well as the manager back very, very significantly. So until something like that happens, you see some mistakes, some implosion, etc. I suspect it would probably stay there. The other reason, of course, which, also to put it this way, that in today's environment where things are far more difficult from a revenue perspective for our wealth management partners, distribution partners too, products like this offer more flexibility as far as revenues, etc. are concerned, which also helps. So that's at least a few of the reasons. That's at least a few of the reasons why.
Okay. So I'm not going into that revenue discussion here, but let me go to Ashish. Ashish, there was this AIF regulations which got announced a couple of years ago, and to a large extent you're also representing the mutual fund industry. Now, do you see this as a threat taking away market share from the HNI segment? Of course, that's what it is basically catering to. So do you see these regulations as a threat?
So I'll answer this in sync with what I said in the beginning. See, look at, first is equity overall. See, look at AIF, you look at PMS, you look at mutual funds. Any or all of these are basically asset class and portfolio manager. So they're just types of licenses, but eventually the return comes from the asset class and the competency of the guy managing it. So they're just wrappers, okay, they allow you to do different things. Overall, if you see, we are as a country dramatically underweight equity. Whatever we own is as good as not good quality. So my sense is that in the bottom of the value chain, mutual fund is just an introduction to professional management, or say, somebody we have like 10-12 lakh crores worth of shares. If we expect all those guys to sell all of that and go to a mutual fund, it's not going to happen. So you need a PMS to kind of pull them there. So I would say mutual funds and PMS are these kind of funneling effect, that from somewhere in the entire lake or pond, you are getting people into professional management. And I wouldn't look at it as cannibalization. I think there is some bunch of people who will evolve, and they need to be thrown upwards. A guy who puts 100 crores in a mutual fund, maybe he's actually an AIF client. I don't know. There are pricing flexibilities. There are what you can do and what you cannot do. So I think that if you are running a mutual fund business and you expect all your clients will be 50 crores, then you are in the wrong place.
Right.
Yeah. So we are very clear what segment of the market we can cater to.
Right.
And we need to be very clear what segment of the market other vehicles can cater to. Right. So mutual fund has to be mass retail or mass affluent. PMS has to be an introduction to professional management where you tell people don't do it yourself, give it to us. AIF has to be in that sense slightly more evolved. So it's what strategies you park on it, what kind of client segment you attract with it, and at the end of it there is always this volume versus pricing thing. So if you can't have a mutual fund business with 1,000 crores of AUM and 10 crores of profit, maybe not. But yeah, you can have a mutual fund business with 20,000 crores of AUM and 50 crore profit. When you're managing an AIF, you will make the 50 crore with 500 crore of assets. So that's the difference.
If I could just add to what Ashish said. See, my sense on the question asked is the following, that when you look at and I'm using firstly, I believe they're complementary, they're not competitive at all. In fact, in terms of space and size, look at the AIF industry, and while the AIF industry has had a pretty good start, when you look at the growth, at this point it's still piffling. It's still really small relative to not even leave bank deposits, but even compared to, let us say, the mutual fund industry, right, which is more mainstream, far more, and I'm even saying mutual fund, X liquid funds, X short-term plans, and so on. You know, I'm talking about, let's say, public equities and so on. So it's still one very small. The other thing which I think is very important in alternate assets, which I just take the liberty to touch upon, is the following: is that, you know, even when you look at the AIF data which comes out of SEBI, there's a huge difference between, let us say, committed and deployed, or, you know, and what does that tell you? Or what it tells me is the following: is that there's a lot more money seeking to invest in such assets, or are prepared to commit to invest to such assets. Unfortunately, the ability to deploy that, the challenge is that, you know, so, you know, one very, very significant thing out there, and I'm digressing a bit from your original question, is that the appetite, to my mind, which alternates can attract is far more. The key things here are, does it have, is the ability to actually execute, i.e., technically, if I can lend to developers at 20% per annum and that money comes back always perfectly, the market should be almost unlimited, right? But the key challenge is that your ability to go out and get good quality developers to be able to lend in, you know, you get the entire thing. And the same applies, I'm sure, for, you know, other markets, and, you know, my other colleagues can speak for themselves. But there's only that much, because there are only two liquid markets in this country: government securities and public equity, and that too in the, you know, primarily the top 100, 150 stocks. Beyond that, it's supply which virtually determines demand. And at least that's my take on it. So my sense is that, you know, this industry would be small. I hope it grows, because we are a part of that, and we believe this should grow very, very strongly, especially when institutions come in. Because the other thing is that this is essentially a domestic HNI market today. The AIF industry is a domestic HNI market. Globally, alternates, if I don't remember the precise numbers, but close to 50% comes out of institutions. Yeah. Everything which could be an insurance company to God knows what else, yeah, to endowment funds, to university trust, blah, blah, blah. HNIs would probably be 40%, 50% of that. So some of those changes will come, and I think it's for managers, if we can deliver. You know, Ashish said something, sorry, I'm digressing, I would request you to bear with me. But Ashish said something about, right communication, or right talking to your client. But one very important thing which you guys also need to appreciate is choosing the right manager. Because, you know, unlike in public equities, there's not just large cap, mid cap, blended, you know, maybe value. There are so many diverse strategies, most of it with no track record. So the ability to actually, sirs, you know, go out and deliver on that is still untested. So it becomes very, very key, very, very important for when you are choosing the manager, to choose somebody who you believe can deliver on a strategy which is, in many cases, the outcome is as yet unknown.
But in fact, I can add my bit there. So what I think the experience of the AF industry has been is to add more clients to the whole market. Because just to give an example, what Shehzad does, so there are a lot of HNIs who used to fund real estate developers on an unsecured basis, on allotment letters. I think the whole AIF industry is now cornering that market share of those clients. So definitely, as Ashish said, it's much more complementary. Going on to Radhika, category 3, the so-called, risky AIF, which can take leverage. So say we wanted to do something in line with hedge funds. Now, if you compare the global average of, say, $2 trillion in hedge funds, and you've got less than 1,000 crores in India, there's something wrong going on, because we're not going anywhere as far as that hedge fund industry is concerned. What are the issues which we are facing? Is it tax? Is it understanding? What exactly is happening there?
See, there are multiple issues. I mean, you're comparing the US hedge fund industry is 20, 30 years old. And in India, you've got essentially this hedge fund industry existing on two platforms. One is about category 3, which is 1,000 crores of what Shehzad said is domestic assets, because it can't take foreign capital. And then you've got a couple of $1 billion of offshore India hedge funds. So that is really the investment market. There are a couple of challenges. One is a perception and investor education challenge, which will change over time. So you started, Umang, by saying that it is a risky category, that hedge funds are perceived as risky animals, when the precise purpose of hedge funds is to lower risk and to produce better risk-adjusted returns. If you look at basic derivative instruments, they only came to India in 2003. The F&O market started in 2003. And if you look at most advisor education on derivatives, let alone client education, it's fairly limited. So as that evolves, this industry and the value of that will evolve. The second challenge we've got is that we don't have an institutional market, and Shahzad has touched on this a little bit. What is happening, and we are seeing with ourselves and competitors in EIF, that in addition to HNI, you're starting to now attract some amount of corporate capital in some strategies. So some of the lower risk strategies that are consistently delivering are also attracting family office capital, corporate treasury capital, and as that trend continues, I think you'll see this industry attract more capital. The third is definitely tax. Tax is something that we have talked about and our industry has talked about, continuously. And with tax, there are two problems. There's a perceived problem and then there's an actual problem. While everybody would want a lower tax rate, much of the challenge is convincing clients that even post-tax, we are adding value. So if you look at an AIF, if it's able to reduce your downside to maybe 1/3 of market downside and match equity upside, even on a compounded basis after tax, it will add substantial value. But that is a process people have to see, because a sharp 35% cut in tax appears very, very large, when in practice we are probably adding a lot more value. So I think those are the three challenges that we face today.
So let us spend a minute on the fees. And this question can be answered by any of you. So I recently met a fund, which was launched 4 or 5 years ago. They had a drawdown period of 7 years. They've drawn down 30% of capital so far in 4 years, and they've charged 2% per annum. So they've charged almost 10%. So they've charged 10 on 30 so far. Now, how basically, now what is the client going to make after the fund gets over? So is there, I mean, somewhere, on a post-fee basis, does this all add up?
I guess a lot has changed since then, because, if you look at, say, 2007, 2008, even maybe 2010, people could get away with 2x20 structures. I could be wrong, and there are people still claiming to do 2x20, but I don't think there's too much which works at 2x20 unless you can see serious amount of value add, right? So I think those days have changed, and at least what I have seen of late, especially in the AIF market, a lot of people are extremely competitive in fees, and I would believe that the pendulum has swung the other way. Yeah. That, sometimes you wonder, boss, at this rate, you're better off selling liquid fund. Yeah. Because, liquid fund, you can make 60 bips. Why do you need to take all this song and dance to make that sort of money? At least that's what I think. But so I think this pendulum has gone the other way. So what I would believe that, obviously there are excesses which happened in the past, which clearly investors are no longer, and rightly so, no longer prepared to accept, and consequently there is more.
No, in fact, I have a different view there. So,
okay.
Am I audible at the back? Too early to ask. Sorry. Hello. Yeah. But this, the fee change. I've seen this happening in real estate funds, but it's not happened in private equity.
Yeah, but come on. I think the focus, like Adhika said, right, people are focusing a lot on taxes, right? And then you focus again on fees, right? I mean, just because a product is low fee, right? Unless it's a debt product, it's not necessarily better.
Perfect.
Right? Unless it's a fixed return product, right? So I think what is lacking is probably norms, right? And fair comparison. And especially in private equity, there are two challenges. Funds, local funds, VC funds are becoming bigger and bigger. Now, I'm thinking if somebody raises $500 million, keeps owning like maybe 20% in each company, right? They got to return to even double the fund, which is like nothing. Okay, let's say treble the fund. They need to return something like $5-10 billion valuation kind of companies, and there are probably only 1 or 2 companies in the whole country like that, right? Okay. So as an asset class, it's PE funds cannot move a lot of money. Cannot just make sense to keep raising larger and larger funds, which to some extent is happening because of of the fee issue, right? At the same time, the best funds globally in the PE space are actually charging 330. It's outrageous. But they do it because they have access to the best deals. So just because, in fact, they are the funds who are never open for anybody outside, only existing investors.
Correct.
So there's a conundrum, and I think, yeah, but markets should have some norms. Even in our space, we are seeing outrageous terms. But even a 7-year drawdown itself, for example, I don't know. You draw down over 7 years, like what you return, like what when people are dead, or I don't know.
True.
I'll add a point on fees. I guess this is a topic that everyone has an interest in. I think having spent time in the US in an institutional market and in the Indian market, I think Indian HNIs, even at a very small ticket, are much more sensitive to fees than global institutional investors at $100 million ticket are. And some of that is a reality. I think the market we are referencing is a market that has very high distribution costs. And that is something that we have to address. So net of client fees, distribution fees, the manufacturer also has to make money. And I was telling one of the distribution partners this, that in a scenario where you're making liquid fund kind of fees for doing hedge fund or real estate investing, you will question whether you need to do that in the first place. So some of this is a challenge of the market. Yes, there are outrageous terms, but a lot of people offer very competitive things. But clients have to be cognizant that there's a distributor who's doing work to service you, there's a manufacturer who's doing work to run an infrastructure, and so there will be a certain amount of fee that is built into the structure.
Perfect. So I think we have less time on hand. So what I'll do is I'll play a quick rapid fire round. So one question to each of the panelists. So I'll start with Radhika. Category 3 AIF AUM after 3 years. 2,000 crores, 5,000 crores, 10,000 crores.
At least 5,000.
Perfect. Anand, Flipkart. In 3 years, flat returns, double, multiplier.
5x.
Okay. Public market returns, Ashish, in 7 years, 2x, 4x, 6x.
At least 4x.
4x. In the same time frame, real estate returns?
Debt would be about 15 to 20% per annum. Equity, maybe a little more than that.
Okay.
I get very insecure sitting next to Shehzad because basically he's saying that debt karo real estate, debt karo equity karo, jo bhi karo real estate mein karo.
Correct.
No, I don't mean that. We've got a very significant public market business too. So, we love public markets and we believe it's a great place to be.
Good. And angel funds in the same 7 years? 2x,
Returns,
4x, 6x?
Again, like the best funds will probably do 5x over 7 years, but I think 80% of the angel funds will struggle to return even just pure capital.
That's true. Arbitrage returns, Radhika, 3 years later.
Liquid plus 3-4%.
Oh, really?
Oh, cash futures arbitrage?
Yeah,
cash futures arbitrage, liquid or less.
Or less.
Liquid or less. Liquid minus 1 or 2.
That's interesting. Okay, and Shehzad, one last one for you. Most sought after real estate asset class after 3 years? REITs, residential, or debt?
As in residential, as in buying.
Buying residential and selling residential.
I guess debt.
Debt?
Yeah, I guess debt. Not REITs.
Okay, so we have very few minutes left for the panel to get over. We've got some time for questions, but before we start the questions, maybe this was not planned, but a show of hands, if you had to invest 100 rupees, which asset class would you invest in? We'll do a show of hands quickly. For absolute return? Oh, you've got one at the corner there. Okay. Public markets? Okay. Not bad. Real estate? Okay. Angel investing? Oh, you got a lot. Oh, good. Sorry? Somebody said? Good one, thank you. So, any questions before we wrap up this panel?
Any benchmark to see the performance of PMS comparing to mutual funds?
Any benchmark?
To judge whether PMS performance is better or, relatively.
So I'll answer that. Sir, I'll just, I get asked this question at least 5 times in a day, very regularly. Your benchmark should be where you're coming from. I'll just clarify that to you. Most of the times I go and offer my PMS is to a client who's holding a portfolio of stocks in his demat account. So the first thing I ask him is, do you know how you have done in the last 5 years? And all the answers I get are anecdotal. मैंने ये भाव में ये खरीदा था तो उसका भाव आज ये हो गया. So what I've seen is that the clients who I meet are in reality not calculating their own performance. So the first thing we do is we backtrack and we check what is the return on their portfolio, and we compare how we have done on our portfolio in the same time frame. So to give a straight answer, the first benchmark is how the client would have done if he hadn't invested with a professional manager. That's why I said in the beginning that the appreciation of what a professional manager can do is pretty much lacking. That's the first. The second thing is that PMS and mutual fund is strictly not comparable. I mean, if you tell me that you want to see the returns, I'm happy to show it to you, and I know PMS has beaten mutual funds, at least in our case. But if I have to compare, I wouldn't compare, because the most important thing in a PMS, it's your portfolio held in your demat account. In a mutual fund, you may invest today, but tomorrow there'll be a zillion people who will come in and a zillion people who will go out, and mutual fund performance gets seriously impacted by inflows and outflows, and your buying price and the returns gets averaged out, whereas in a PMS, it's your portfolio in your demat account at your buying price. It has nothing to do with the sum total behavior of so many people. So I sincerely believe that when you're comparing a PMS and a mutual fund, you're actually comparing apples and oranges, and the net outcomes. You know, you may always say that this guy in 12 years gave 25% compounded, another mutual fund in 12 years gave 25% compounded. The numbers may look the same, the journey and the experience is totally different.
Any other questions? Yes.
Financial services industry as such. I'm saying you don't see too many people coming in this industry. Even whether you take a software in the financial service industry or you take asset managers. So is there
is a emerging space. You know, if you heard of this company called Lending Club, where people can pool money and lend to a businessman or a consumer. Technology is emerging in these things. Core banking technology, for example, is itself shifting with use of Bitcoin. We have a Bitcoin conference going on in Rishi Desai's office today. I had to skip that to come here. So, you know, I think fintech actually, see, every industry has been disrupted. If you look at hotels, this company called Airbnb just took the wind out of hotels, and suddenly you have a completely parallel capacity, right? Similarly, in banking, you know, mutual funds and, you know, various asset managers have taken away businesses from, let's say, Edelweiss, for example, right? A lot of business houses or independent initiatives have taken away these businesses away from banks, right? So similarly, you know, lending side also, you know, a lot of technology companies are taking away business from the banks. And distribution, there is a bank in UK, a pure mobile app only bank, for example, no branches, right? So I think the industry is up for serious disruption. In India, RBI has a little bit of a soft corner for existing banks. You know, there's a very nice oligopoly. You have Axis Bank, HDFC Bank, ICICI, SBI. All four sort of decide the rules to play. But once that changes, you'll see a very, very big difference.
and on the distribution side?
On the distribution
of financial products, basically.
See, I think these guys will tell you how challenging it is to distribute products to retail. You know, almost everybody is talking about either institutional or mass affluent, right? Mass retail is very difficult. In India, mutual fund, again, you're talking of probably somebody corpus of 25-50 lakh and above, right? So distribution plays work typically when retail is involved, right? If it is going to be a high ticket sale, it's better done with a personal meeting.
No, I'm saying disruptive, can it come from the technology on the distribution of mutual funds or insurance sometime going
The
forward?
existing consumer demand is not strong today, right? Once that catches up, technology will play a big role. So even today, insurance, for example, right? I mean, very, very small part of insurance is now slowly shifting to online purchase. Maybe travel insurance. But that is much slower comparatively than, let's say, ticket buying, right? I mean, like 50 years ago, 20 years ago, we used to buy leaflet-driven tickets from travel agents, if you remember. Right? That's stopped today. But insurance, mutual funds, very, very, there are a few companies, not much.
Okay. Anything else? Or we have
Okay, Monk, that was a lovely session. Very insightful, brilliant, really learned a lot. May I invite Nand Kumar CEO of JP Morgan AMC, to come and felicitate the panel.